here's a question that could cost you thousands of dollars over the course of your retirement. And that question is should you buy an annuity now? Should you wait another 6 months or a year, or maybe wait till you're retired? Or are annuities just a four-letter word? And really what happens is we're living through one of the most dramatic interest rate environments in decades. Here we have interest rates at the highest point they've been really since my children have been born. I have a 22-year-old and an 18-year-old. My 22-year-old is in the process right now of getting his first house, and he's, completely shocked at where mortgage rates are at, right? Because he's used to hearing mom and dad talk about, having 2.5% mortgage rates, and now they're 7.5%. So higher interest rates may be negative for somebody who's looking to take on debt, like my son who's getting a mortgage. But, for those of you that are savers and you're looking to save either for now and or in the future, making sure that you're taking advantage of this interest rate environment can really be an optimal time. Here it is in the middle of 2025. If I go back about a year ago, interest rates were a little bit higher about a year ago. The Federal Reserve has indicated their plan is to lower interest rates in the future. So this really still may be an ideal time. Again, dependent upon what your opinion is of annuities, what I want you to do is I want you to get educated about it, because if you're considering an annuity for income, the difference between buying now versus waiting till interest rates go down literally could mean the difference between 10 or 20% and more guaranteed income in retirement time. And the problem is most people have no idea that annuities are basically interest rate products in disguise. And so when interest rates move, everything changes. Your potential return, the amount of income that they guarantee, even how much you could lose if you cashed out early because of something called market value adjustment. So really in this segment, what I want to do is I want to walk you through exactly what type of annuities are impacted when interest rates change, because in this rate environment, timing isn't just important. I think it's really everything with where we're at right now in the interest rate cycle. Interest rates have a direct and significant impact on annuities, specifically when you're talking a fixed annuity, also sometimes referred to as a multi-year guaranteed annuity, and it also has an impact on fixed indexed annuities. The income guarantees offered by many of these products change based upon where interest rates are. And here's how interest rates really impact the annuities, broken down by the different types and what the features are. So first you have a fixed annuity. And again, I'd refer to a fixed annuity also as something called a multi-year guaranteed annuity. With a multi-year guaranteed annuity or a fixed annuity, you can lock in an interest rate for 1 year. You can lock in 3 years, 5 years, 10 years. Those are the typical terms that you would see with being able to lock in interest rates. And so when interest rates go up, like what we have seen happen, insurance companies have the ability to offer you a higher credited interest rate on the new fixed investment accounts that come out. So you get better guaranteed yields on your money. Insurance products are backed by the full faith and credit of the insurance company that you work with. So you really want to understand, what is the rating of the insurance company? I would say when you're comparing products, they're most similar to like CDs, where you buy a CD for a 6-month, 1 year, 3 year, 5 year time frame. You get a fixed rate of return for that set time frame. At the end of that time frame, you can renew it at whatever the rates are there. You could take and move it somewhere else. The difference is, again, these are insurance products, so they're not FDIC insured. So payouts from immediate annuities, if you're in retirement time and your desire is to have immediate income, or if you're say 5 or 10 years out, those people that are 5 years or 10 years out from retirement time, having reliable income is extremely important to them as well. These income payout ratios oftentimes rise because when interest rates are higher, the insurance company has more money in the reserves that they have. I had met with a gentleman last week. We were talking a little bit about building out a bucket of money designed for healthcare. And, he had a real concern about deploying money into a bucket because he didn't feel comfortable to know that he had enough money to last forever. Looking from the outside in, I could see that, he has enough money, but I can also appreciate the fact that he just recently retired. So he went from, getting a normal paycheck by getting up and going to work every day. And, looking at his pile of money, he said, well, how would I get comfortable? And that's figuring out how to have more reliable income. So getting a system in place that has those regular paychecks that come in for a set period of time and or for the rest of his lifetime. Those are things like immediate deferred annuities can provide as well. Those are additional benefits. When interest rates go down, so like the Federal Reserve is talking about lowering interest rates, if that happens, new contracts are going to traditionally offer lower rates, reducing those income payouts. It's going to reduce your growth potential that you have. You're going to lock in maybe a lower rate. The existing contract, though, so for those people who have locked in rates at where they're at today, those rates are going to remain guaranteed for the length of time based upon how their product that they set up. So if you bought, a 5-year contract and you got an interest rate, even if interest rates go down in a year from now, the insurance company is still contractually obligated to pay you that interest that you agreed upon, even if new contracts get lower rates as well. So again, you want to know about the length of term of what your contract is, and take into consideration how long you'd like to lock in that money. There's a lot of people that like to have their money very liquid. No doubt about it, there is value into having liquidity, whether you're working or whether you're retired. But there's also a cost of liquidity. The best example that I could give of cost of liquidity is, if you keep all of your money in a money market account, and money market rates are great today, but, as interest rates go down, those money market account rates will go down just when interest rates go down. Where if you had a product that's locked in for a longer period of time, now you have peace of mind that even if interest rates go down, you've locked it in. I've had folks that we've met in with recently that said, hey, can I lock in this rate for the next 10 years? I just don't even want to think about it. And I just want to live off of the interest because of where the rates are at today. I want to lock in my rate for a longer period of time. So in 3 years from now, I don't have to worry about where rates are. The other financial product that is impacted by interest rates are what are oftentimes referred to as called fixed index annuity. So a fixed index annuity is a type of an account that allows you to participate in either a percentage or a maximum amount of growth of an underlying performance of an index. So, again, if the S&P 500 index, it allows you to participate when that index goes up. It usually has a floor of 0, meaning that if the index goes down, you're protected. But those type of products also allow you to have higher potential when interest rates are up. So what you can get is you can get a higher cap rate. Think of a cap as the maximum amount. If I go back a couple of years ago and I look at where cap rates are, you might have a product that it would be common that the maximum that you could make on any given year would have been 4%. There's products today that may allow you to get 7 or 8% is what the cap is. So you've seen cap rates go up as interest rates go up. Participation rate. A participation rate means what is the percentage that you get of the good. 5 years ago, you might be able to get 25% of the good. So if that underlying index went up 10%, 25% of that is 2.5%. You could see a participation rate today that would be, 40 or 50%. So if the market went up 10, you could get 4 to 5% on a participation rate. So, the higher is going to allow for more growth potential. Insurance companies can offer more favorable terms, again, due to better bond returns on their end as well. And so when interest rates fall in the future, you can have the offers get lower from the insurance companies. They can lower the cap rates. They can lower the participation rate. Some insurance companies offer upfront bonuses when you open up an account. Those can also go down or be reduced based upon where rates go in the future as well. When you look at immediate annuities, you look at annuities that offer what's called income riders. Higher interest rates mean higher payouts, period. So these products are really priced using current interest rates and life expectancy. And as rates go up, insurance companies can afford to offer larger monthly income payouts for the same premium. Lower interest rates equal lower income. Lifetime income payments can also shrink when rates go down and rates are lower. And that's because income riders in a deferred status often grow slower when the general interest rate environment is weak. The fourth category, which is kind of a hidden category within annuities, is called market value adjustment. A lot of annuities have something called market value adjustment, and it can impact what is called the surrender value of your contract. Always want to pay attention to what your contract details are. Surrender charges refer to penalties if you take out more than what is the free withdrawal amount available from your contract. And what a market value adjustment does is, based upon where interest rates are, can impact what that surrender value is. Some fixed index annuities have that feature, other ones don't. It's going to, again, impact your contract if you surrender it before your contract term, you surrender it early. If interest rates have risen since purchase, the market value adjustment could ultimately reduce the surrender value. So interest rates up, market value adjustment bad. On the opposite, if rates have fallen, you could receive more than expected upon surrender. So again, interest rates go down, market value adjustment may be a positive thing for you as well. Again, know that your contract and know what the parameters are of your contract so you have a full understanding of them. But again, the basics here are as interest rates go up, that's a positive for things that are in the fixed investment world, like annuities. When interest rates go down, that can be a negative. You know, there is the invisible hand. Obviously, you don't have control of what happens with interest rates here. Right now, we're in a unique environment where we've seen great interest rates. They still have relatively not changed a whole lot in the last year. The Federal Reserve is talking about lowering interest rates. So if you're considering a fixed or a fixed index annuity, or maybe you're looking for, you know, more guaranteed income, keep in mind that this is based upon the claims paying ability of the issuing insurance company. But, you know, I think your window of time right now is one of the best times that we've seen in years. Timing the market's tough, right? Timing when to purchase annuity can also be tough. So my advice to you is the current environment, if it meets what your needs and your goals are, if you're looking to maybe lower some of your risk tolerance, if you're looking to maybe take some money out of those risky assets while we're in a good environment, before something bad happens, find out about what your choices are. Focus on finding a product that is, you know, reasonable or has no fees. In terms that make sense for what you're trying to do in your specific situation. A great annuity is one that really allows you to sleep well at night, regardless of what interest rates do in the future. And, you know, I get that this is a confusing topic, so hopefully we'll walk you through a little bit of a different approach. If you have an old annuity, if your annuity is 5 years or older, can also be worth having a second set of eyes to review to find out if you have the ability to look at some upgrades on what you're doing today as well.